There's a certain magic in the idea of finding an overlooked treasure, isn't there? A stock hidden away from Wall Street's relentless gaze, quietly building value, waiting for a discerning eye to recognize its true worth. This quest for the underrated stock, the hidden gem, is as old as investing itself. It speaks to our deepest desire not just to grow wealth, but to do so with wisdom, with an edge, by understanding something others miss. But here lies the fundamental dilemma, the whisper of caution in the heart of every serious investor. How do we truly distinguish genuine undervaluation from a stock that is simply cheap for a reason? How do we avoid mistaking a flickering candle for a guiding star? Benjamin Graham, the father of value investing, offered a profound insight in the intelligent investor. The investor's primary task is not to find companies that are selling at a bargain, but to find companies that are selling for significantly less than their intrinsic value. This is not about chasing low prices. It's about understanding deep, intrinsic worth. It's about looking beyond the ticker symbol and the daily fluctuations to the underlying business, its strengths, its potential, its true value. This distinction is crucial. A cheap stock might be cheap because its business is failing, its future uncertain, its bargain a siren song leading to ruin. A truly underrated stock, however, possesses an intrinsic value that the market, for a time, has failed to recognize. It's a subtle but profound difference, and it's the difference between a lucky guess and intelligent investment. Over the next few minutes, we will embark on a journey to uncover these hidden gems. We will move beyond the superficial allure of a low price tag and delve into the data, exploring for critical signs that point to genuine undervaluation. These aren't mystical secrets, but rather data-driven indicators that, when understood and applied rigorously, can help you identify those overlooked opportunities, those companies poised to reveal their hidden value. This is about sharpening your analytical gaze, about understanding the language of numbers to find the true story of a business. Our first sign of an underrated stock lies in its silent strength: consistent, sustainable free cash flow. This is the lifeblood of any enduring business, the true measure of its vitality, often more telling than the headline earnings figures we are accustomed to seeing. While accounting profits can be manipulated or influenced by non-cash items, free cash flow, or FCF, represents the actual cash a company generates after accounting for all its operating expenses and capital expenditures. It's the cash that's truly available to the owners of the business to reinvest, to pay down debt, or to distribute. Think of it this way: net income is like the projected harvest from a farm based on anticipated yields and market prices. Free cash flow, on the other hand, is the actual grain stored in the silo, ready to be sold or used. A company might report a bumper crop on paper, but if it can't convert that into tangible, usable cash, its long-term prospects are far less certain. Focusing solely on price-to-earnings ratios without examining a company's ability to generate free cash flow can be like buying a beautiful but empty vessel. How do we gauge this silent strength? A powerful metric is the free cash flow yield, calculated as free cash flow per share divided by the stock price. A high and stable FCF yield is a compelling signal. It suggests that the market is not yet fully appreciating the cash-generating power of the business. It indicates that for every dollar you invest, the company is returning a significant, consistent stream of actual cash. A company that consistently generates free cash flow is like a well-tended garden, capable of producing fruits season after season, irrespective of the daily weather reports or the fleeting whims of the market. This sustainable generation of cash is a bedrock indicator of a business's fundamental health, and often a precursor to its market recognition. It's a quiet testament to a robust business model that the market may have, for now, overlooked. Our second sign points to the quiet strength of a durable competitive advantage, what Warren Buffett famously calls an economic moat. This is the invisible shield that protects a company's profitability from the relentless assault of competition. Often, it's precisely these moats, these deep, defensible advantages, that are overlooked by a market focused on quarterly earnings or fleeting trends. What constitutes a moat? It can be a powerful brand that commands customer loyalty, like the enduring appeal of certain luxury goods or beloved consumer staples. It can be proprietary technology protected by patents, giving a company a unique edge. Network effects, where a product or service becomes more valuable as more people use it, create incredibly strong moats. Think of social platforms or online marketplaces. Or it could be a significant cost advantage, allowing a company to produce goods or services more cheaply than anyone else. When a company possesses a widening moat, its ability to generate consistent returns grows, yet the market may not yet fully price in this long-term security. Conversely, a company lacking a moat is like an open field, vulnerable to any passing storm. Even if its stock appears cheap today, without a defensible advantage, it's susceptible to price erosion and competitive threats, making that low price a potential trap rather than a hidden gem. To identify this moat, we must look beyond the surface. Analyze the company's competitive landscape. Does it have pricing power? Can it raise prices without losing significance? significant business? What are its customer retention rates? Are customers loyal, or are they easily swayed by the next lowest bidder? We are searching for signs not just of a moat, but of a moat that is growing stronger, becoming deeper, more impregnable. A company with a strong moat is like a castle with deep foundations and high walls. It can weather economic storms far better than an open field. This enduring protection is a hallmark of many truly underrated, yet fundamentally sound businesses. Our third sign requires a skeptical eye, a deep dive into the stewards of the enterprise, the management team and their capital allocation decisions. It's a truth often obscured by marketing gloss or exciting new product announcements. The quality of leadership, and more importantly, their ability to wisely deploy shareholder capital, is a critical, yet frequently overlooked, driver of long-term value. Management's choices, whether to reinvest profits back into the business for growth, return capital to shareholders through dividends or buybacks, or pursue acquisitions, have profound implications. We've seen companies with seemingly robust businesses falter under the weight of poor capital allocation. Conversely, disciplined management teams focused on maximizing intrinsic value per share can unlock incredible wealth, even in less glamorous industries. We must be wary of the growth at any cost myth. Management driven by ego, by the desire to build an empire, can often lead a company down a path of value destruction. Chasing growth for growth's sake through ill-advised acquisitions or excessive spending can dilute shareholder returns and mask underlying inefficiencies. This is a behavioral trap that can ensnare even intelligent investors if they fail to critically examine management's true objectives. So, what should we look for? Transparency is key. Read the annual reports, the shareholder letters. Does management speak plainly about the business and its prospects? Are they shareholder-centric in their language and their actions? Do they articulate a clear, logical strategy for deploying capital? And do they have a track record of making prudent decisions? Management is the captain of the ship. Even with a sturdy hull, a poor captain can steer it onto the rocks. We seek captains who are stewards of the vessel, who understand that their primary duty is to protect and grow the value entrusted to them by the shareholders. Their actions, more than their words, will reveal their true worth. Our fourth and final sign is crucial for avoiding the dreaded value trap. This is where a stock appears cheap, but the underlying financial structure of the company is precarious, masking a deeper, more dangerous reality. We must become detectives, scrutinizing the balance sheet to ensure that apparent cheapness isn't a mirage hiding financial distress. Key to this investigation are metrics like the debt-to-equity ratio, which reveals how much debt a company uses to finance its assets relative to shareholder equity. We also look at the current ratio and quick ratio, which assess a company's ability to meet its short-term obligations. In today's economic climate, excessive debt is not just a burden, it's an amplifier of risk. A highly leveraged company, facing even a minor downturn, can find itself in a desperate situation, forced into actions that decimate shareholder value. Imagine a company with a low stock price enticing us with its apparent bargain, but beneath the surface, it's drowning in debt. When times get tough, this debt can force management's hand. They might have to issue more stock, diluting existing shareholders' ownership, or sell off valuable assets at fire sale prices. The illusion of cheapness evaporates, revealing a company struggling for survival. This is the essence of a value trap, a stock that seems cheap, but is cheap for very good and often hidden reasons. Therefore, a systematic analysis of the balance sheet is paramount. We are looking for companies with robust financial resilience, those that carry manageable levels of debt relative to their cash flow and equity. A strong balance sheet is like having a robust emergency fund. It provides the stability and flexibility to navigate unexpected financial challenges without crumbling. It's the quiet confidence of a business built on solid foundations, a vital characteristic of truly underrated stocks poised for genuine appreciation. We've explored for critical signs that can help us distinguish genuine undervaluation from mere cheapness: consistent free cash flow, durable competitive advantages, prudent management with sound capital allocation, and a healthy, robust balance sheet. The true power, however, lies not in examining these signs in isolation, but in synthesizing them, weaving them together to form a holistic picture of a company's intrinsic worth. Each sign acts as a lens, and when viewed together, they reveal a clearer, more accurate image. A company with strong free cash flow, a wide economic moat, disciplined management, and a solid balance sheet is not just a cheap stock. It's a company with a high probability of enduring and thriving. These factors don't just coexist, they reinforce each other. A strong moat allows for consistent cash generation, which in turn enables prudent management to maintain a healthy balance sheet, creating a virtuous cycle of value creation. This is not about gut feelings or a mystical intuition. Finding undervalued stocks is an analytical endeavor, a disciplined process grounded in data and critical thinking. It's about challenging the prevailing narratives and looking deeper, armed with the right tools. To help you in this expedition, consider building your own underrated stock scouting report. This report would systematically assess each of the 4 signs we've discussed, creating a structured framework for your analysis. The journey to uncovering hidden gems is not a lottery ticket, but an expedition guided by rigorous analysis, a compass of critical thinking, and a map of fundamental value. By consistently applying these data-driven insights, you move from passive observer to active architect of your financial future, capable of identifying those overlooked opportunities that the market, its sometimes myopic focus, has yet to fully appreciate. We've journeyed through the landscape of undervalued stocks, moving beyond the superficial allure of a low price to uncover the bedrock of genuine intrinsic value. We've seen how consistent free cash flow acts as the steady heartbeat of a healthy business, how durable economic moats provide a fortress against competition, how prudent management steers the ship with wisdom, and how a strong balance sheet offers the resilience to weather any storm. These 4 signs are not mere indicators, they are the pillars upon which sound value investing is built. They are the tools that help us distinguish between a stock that is simply cheap and one that is truly underrated, a company whose true worth the market has yet to recognize. It's the difference between picking up a discarded cigar butt, as Benjamin Graham might put it, and acquiring a genuine treasure. As Warren Buffett wisely advises, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Our signs help us identify that wonderful company, that business with enduring quality, even when its price tag doesn't yet reflect its full potential. Applying this analytical framework requires diligence, a commitment to data-driven truth, and a healthy dose of skepticism towards conventional narratives. It's about developing the discipline to look past the noise and focus on the fundamentals. So, I encourage you now to take these insights and begin your own scouting expedition. Start by reviewing the companies you already know, or those that catch your eye, through the lens of these 4 signs. Assess their cash flow, their competitive advantages, the character of their leadership, and the strength of their financial foundations. This is the path to informed decision-making, the foundation for sustainable wealth creation. The search for hidden gems is an ongoing process, a continuous learning experience. We will continue to explore deeper valuation techniques and dissect specific industries in future discussions, always with the aim of equipping you with the knowledge to navigate the markets with confidence and clarity. The true value lies not just in the stocks you find, but in the analytical rigor you cultivate along the way.